This is just to remind people in the audience, and I'm conscious this is an investment conference, that for the mining industry per se, and I'm a mining engineer, that is the list of the value of mines, mined production last year. Left column is how much was mined, middle column, all in dollars per tonne. So if you buy diamonds by the tonne, it's 535 million. But the important line is the last column. Coal absolutely dominates still, deeply unsexy commodity, of course. Iron ore and copper are the next most important. Gold is the fourth most important metal mined. So for equipment manufacturers, it's all about those top four commodities. After that, from a mining perspective, equipment and the like, they do not matter. And that's not to take away from the battery metals, obviously a huge investment potential, but from the terms of the sale of commodities and equipment, it is only those four commodities. Incidentally, obviously you can have copies of these slides. They come from the quarterly reports Standard & Poor's does, or S&P Global does. A reminder of where we are, 10-year price trend, truly horrible for 5 years. We bottomed in January 2016. It wasn't difficult to call the bottom. We weren't going much lower. I've got lots of graphs that can demonstrate that. And since then, there's been a clear recovery. We also plot global drilling. These are all the projects reporting drilling. We do it on a monthly basis, but this is quarterly. Good news is we're clearly on an upward trend. This conference comes 2 weeks too early for the March report. That gets filed on May the 17th. You'll see there I circled the December quarter for each of the last 5 years, clearly on an upward trend, but from an extremely low base. Financing, I haven't got time to dwell on this. Suffice to say it was a truly shocking December quarter after a very encouraging September quarter. I haven't got the numbers yet for the March quarter, but it can only be better. TSX, as you're probably aware, third of total financing. And that's where we are from a market cap. We obviously plot this in real time. That's the 2,500 listed companies. We hit 2.3 trillion at the peak. Pretty diabolical downtrend. Bottomed at 750 billion in January 2016. Clear recovery since. January this year was up. We were back to about 1.7 trillion. February and March, awful. We're back down below 1.5 trillion. Just to conclude, this isn't my work, this is our ratings guys. If you needed reminding, we're not well rated. There are no mining companies that are rated better than A+. And I didn't look it up, but there's 3 companies rated D. The mining industry as a whole does not get much investment, very high ratings. The good news is we're still negative outlook, but it's clearly improving. And S&P ratings reckon we're going into the positive territory for the first time since the recession, the bear market started. So I'll turn that slide off, even though it's an encouraging one. A quick introduction to our 3 panelists. On my far right-hand side is Geoffrey Couch, Managing Director, Head Investment and Corporate Banking of Europe, BMO Capital Markets. A lawyer by training, Mr. Couch is also a Bachelor of Business Administration. He joined BMO's European Investment and Corporate Banking team in 2011 to focus on metals and mining and transactions. And he's been in metals and mining investment banking experience. He has about 16 years of experience, having previously been Head of Business Development at Eurasia Natural Resources. Before then, Jeff had 15 years of experience with Credit Suisse, Citigroup and Kleinwort Benson. Shea Small, nearest to me, another co-leader global mining, McCarthy Tétrault, another leading mining lawyer from Canada. Mr. Small serves on McCarthy's executive as International and Business Strategy, and this international practice, based in Toronto and here in London, is focused on mergers and acquisitions, private equity, joint ventures, and capital market transactions. And finally, in the middle, Dean McPherson is Head of Business Development, Global Mining, TMX Group. McPherson is a civil engineer by training and spent 10 years managing capital projects for an international diversified mining company and a major international engineering service company. Prior to joining the TSX, Dean worked as an investment banker, assisting mining companies to meet corporate finance and growth objectives. He's now responsible for the development and execution of the TMX Group's global strategy for attracting new listings to mining sector. I've got a few questions. Obviously, time's a bit restricted, but I'll address them to all three of our panelists. And we kick off with the question nearest to the title for this panel. Metal prices boomed, as you saw on that slide of mine, from 2004 to the global financial crisis at the end of 2007. Prices then recovered strongly in 2009 and 10 before a 5-year bear market that bottomed at the start of 2016. Quite clearly we're on an upward trend now, but is this a reaction to supply constraints, real or perceived, or to burgeoning demand for metals? Jeffrey, do you want to kick off on that?
Sure. I mean, it's blindingly obvious it's both. The supply picture, as we all read and talk about, the demand picture, as we all read and talk about in the U.S., continues to improve, and it is increasingly difficult to bring significant mining operations separate and apart from the gold space, which is a separate category altogether, but for industrial metals, for copper and nickel and all the other metals that are used for industry, it's an increasingly difficult task to put profitable mines in jurisdictions that are not, as somebody mentioned, the DRC or Russia, or very, very difficult jurisdictions. So it's a combination of supply and demand.
Dean?
I agree completely, Jeff. I think it is completely a supply and demand issue, and I think what's different this time around is that the supply side has been constrained for quite some time because of the natural cycle. But I think certainly currently, certainly since the past year or so, the demand has changed significantly, and as a result, I think demand is probably the net driver right now with this constrained supply that we had coming out, which is natural coming out of the downturn.
Shea, you going to agree as well?
Yeah, I mean, obviously, agree with all of that. I would say what we're seeing. One first thing is on the supply side, it's not clear that they're actually that it's real necessarily. Some of it is perceived, and a lot of it is people looking forward to say, in copper, for example, where are the new mines going to come from, and so on. So that's part of what's driving the price increase. The other thing I would say that's driving the price increases are who's playing in the market again. So whereas the strategics were out for many years, for the most part they're back. They're back in varying degrees of how back they are, but you're seeing it in your practice as well, I'm sure, that a lot of our retainers now are from strategics who years ago were doing divestments, and that was sort of that was the only game in town, to we are looking actively at acquisitions across the board, and you're seeing some of them come out and do it. That's playing into it.
I'd say one other thing is interesting that's different, or a changing dynamic that we've seen at BMO Capital Markets, and again, may not be as technical a response as you're looking for, but don't ask for a technical response from a banker. But we're seeing new participants on the investment side of the equation. You take a Brookfield, for example, or you take the auto companies, or there's an increasing number of industrial conglomerates that are becoming very concerned, or at least thinking through their business model about how to get in this industry, or how to at least secure supply if they're not at least going to own their own mining operations. But that didn't exist a decade ago.
And is that being led by concerns out of the States? Because certainly in the European Union there's a big move for more secure supply as well. I mean, are those the two blocks that are leading the...
Yeah, I think so. I think there's no doubt the U.S. economy is part of the equation.
I think you're seeing that all over the place, actually. I mean, you clearly have seen it from China, that has been active for quite a few years in securing supply in commodities that they look to as long-term strategic commodities. So they've been going in, and obviously everyone knows they've been active in Africa and a lot of places where a lot of other people, or at least the strategics, haven't been active. You're also seeing it, as the example you just gave, you had SoftBank, the Japanese group, just did the Namaska deal. And that was a 9.9% deal with I think it's 20% offtake if I'm off memory, and that's a security of supply issue. So we are definitely seeing more of that. The other thing that you're seeing more of, I actually think there's more activity on the private equity side in the last 12 months than there has been for a long time before that. There's always been a ton of talk about when private equity is coming. It actually has been coming. It's more on the smaller side of the market. But you do see EMR, for example, in Australia doing some rather big deals. You see, many of the private equity groups are actually...
Appian.
Yeah, they're...
Orion's on Fund 3. Orion's all over the space, as everyone in the room knows, because they're all in the gold space.
Yeah.
Appian will do Fund 2. So, but again, I don't know how much that links to supply and demand.
Yeah.
Yes, there are other people in the space now.
Yeah, I think it's tied into supply and demand. It's the whole global growth, the economic growth globally certainly has taken off over the past year or so. All the forecasts are being exceeded. And so, I think everybody is just responding to the global demand for metals and commodities in general.
So is the asset values between projects in secure countries and less secure countries, is that increasing, the differential price between projects? For example, if you've got a project in Cornwall as opposed to in the DRC, are we seeing that being rated differently?
It's a very good question, and I might have answered the question differently pre the latest drama with Bristow, Glasenberg, and Friedland. Because, even in, and I know it's a favorite mantra, safe jurisdictions, but even in Spain, the United States, Quebec is a slightly different. Quebec is probably one of the most progressive territories or regions in the world in terms of putting their own capital to work and supporting the mining industry. But whether it's Australia, whether it's parts of the US, whether it's Spain, they all have jurisdictions that can change the maths on you and change the licensing arrangement. Now, what we saw in the DRC with a serious response from some of the most influential people in the mining industry that has frustrated some of the most serious people in the mining industry. Yeah, I think there's an asset value. Glencore hasn't been hit as hard, although Katanga today hasn't helped. But yeah, no, they're definitely there's an asset differentiation linked to jurisdiction for sure. Russia, etc.
Do you notice that on the TSX as a matter of interest?
Sorry?
Do you notice on the TSX companies being valued differently depending on where their assets are?
Oh, absolutely. That hasn't changed. I think that's always been the case, as Jeff referred to. The safe jurisdiction clause is well used, and that's I think more important nowadays. Certainly, we've seen investors flee from what they consider to be high-risk zones. What we have noticed, though, is that investors tend to go back. Certainly in our markets, and that's one of the things we pride ourselves on in Canada, is when it comes to natural resources, both mining and oil and gas, to be frank, investors, because of the depth of knowledge and experience that we have in this market, investors, they will go away from flare-ups, shall we say, like the DRC, for instance, and West Africa a few years ago. But after walking away a couple of years, when things calm down, they do return. And that's, I think, a key differentiator.
That leads into... Oh, sorry.
Yeah, and I was going to say, another differentiator, you touched on it briefly at the start, is it's not just jurisdictional, but it's the stage of the project. And if you have a brownfield project in a safe jurisdiction, in a highly sought-after commodity, I mean, as most of us know, the valuations are out of this world sometimes. And on the flip side, if you have a greenfield project, even in a safe jurisdiction where there's a lot of permitting risk, social license risk, etc., they still struggle on the valuation side. So you've seen the valuations really move up on the one side. So even the strategics sit there and go, how am I going to do a copper deal?
I'll tell you the one thing that hasn't changed as much as I would have. Well, I did predict a few years ago, and it hasn't happened. Is that in the diamond industry, you definitely get diamonds with a premium when they're sold locally. Canadian diamonds, for example, are worth much more than diamonds in out of the Congo. And we started seeing that in gold a few years ago, and Welsh gold famously is worth a lot more than gold anywhere else because it's given to the royal family. Do you see any more likely that companies, particularly in diamonds and gold, starting to brand their gold because it is in extremely safe areas, so the Canadians start buying Canadian gold, or is that just not happening? It has in diamonds, but it hasn't in gold.
No, we haven't seen that at all. No. No,
it's probably just the Welsh because they've locked onto where.
You know what? One thing we are seeing that's new is you're seeing blockchain applied to gold, and that will be branded, and it'll be interesting to see which brand survives.
Well, it's blockchain that will allow you to do this, and it's certainly in diamonds. The local populations like to say my diamond is Canadian. And it hasn't happened in gold. Anyway, I digress. But it leads on quite well to the second question I had in mind. That, as I showed on that, January was a particularly good start to the year for mining, and most prices and equity prices went up. But politics finally leaked into the markets in March, and it was an extremely poor month. And I mean, obviously, mainly President Trump. But politics generally is in the market now. Was that a blip, or is politics now driving investor sentiment? Seems to be in London rather than supply and demand fundamentals. I'm thinking of North Korea and all sorts. I mean, suddenly everyone's scared and it's driving prices.
You go first? Yeah, you guys go first.
I think certainly investor sentiment has always been influenced by politics. I think the times have changed over the past almost 2 years now. Since 2016, politics has become a lot more visible or louder, if you will. And so I think from where we sit, we're seeing, March being more of a pause, a time to digest news that often comes in the middle of the night via Twitter. Investors tend to take a step back and to digest that information. So yes, politics is being a larger factor, a larger influence on investor reaction in addition to supply and demand. And I think that reaction is more visible now, only so, not that it was not there before. We talked about jurisdiction risk before. That a large part of that was due to politics.
Yeah.
So,
I think a lot of it comes down not so much to what is actually going on in politics, and whether it's Trump, his Twitter account, or actually the trade sanctions, or even what's going on with Russia. More of it is the uncertainty that it creates, and it's sort of the what's next, how bad can this get, and where that plays into is when you actually look at the numbers on demand, they're really actually not that bad, or on supply. Where they're bad is on people committing capital to make investments, and that's where I think that is the hard part about all this politics is are people going to invest if they don't know what the world's going to look like for them, and how they calculate their IRRs and so on, and that is probably the most problematic part of this.
Because you could juxtapose that with price cycles. I mean, I bore people witless about the biggest single problem for the mining industry is I think price cycles. In that I know any number of good potential students haven't gone into mining because they've just hit the bear market and it's going to go on for 5 years. Mm-hmm. And general investors, they can't possibly invest in companies that, however attractive they feel, if they can see a price cycle moving against them. And are we doomed to go through that? I mean, I'm coming up to retirement. Unfortunately, we're just entering a bull market. But, 5-year bear market, why would anyone go into the industry if it's a cyclical industry? And why are we ever going to get general investors back when they're facing such a cyclical industry? Is there anything that can be done, or is it we just doomed to go through companies over-expanding, producing too much, and we hit the next downturn?
We had the highest portion I don't have the stats with me, but we get all the stats. At our Metals and Mining Conference in February, we had the largest portion of generalist investors we've ever had, and that included from all the significant asset managers. So, we've seen a tangible interest from generalist investors in the sector globally, but generalist investors, especially if they're from grown-up, mature U.S. asset managers or global asset managers, they need a track record. They need to have met the CEO 3 times over 2 years. It's very different than hedge funds or smaller cap investors. So we're quite optimistic about generalists in this space taking a 5-year view.
Right. That's less the experience, I suspect, isn't it? Everywhere. I don't know. Same in Toronto. You've got the general funds in.
Yes. I completely agree with Jeff. We are seeing strong interest from general investors as well, and it's that deep dive into quality of management, quality of asset, and a track record of delivery is there.
But it's clearly still challenging for the junior end of the market, isn't it? I mean,
it is.
What's your outlook for activity on particularly your exchange, but exchange generally? Is it more alternative finance from the industry? Because it looks to me as if the public's gone away.
It's interesting. It's an interesting point. Last year was pretty significant for us in terms of the market. Q4 last year we saw IPOs returning to the marketplace. We had 3 huge IPOs last year in Nexa, Euro Copper, and Titan, base metal plays, South American names, except Titan, which is New York based. But we saw 3 big IPOs raising almost $1 billion last year on our exchange. Nexa, which was the largest part of that, did a dual listing in New York as well. But it was significant because we hadn't seen a significant IPO in mining in the markets, I believe, since 2012. So that was significant, and as we all know, IPOs are significant in terms of signaling a change in the marketplace. We also saw an increase last year in the mining sector in interlisting or dual listings that are mining companies that are listed either in Australia or in London here, looking to enter the North American market and came listing on the Toronto Stock Exchange or the TSX Venture. So Q4 last year was very good, very encouraging, and talking to all our partners, they were extremely busy, the busiest that they've been in 5 years or so. So 2018 started out very well. As you mentioned, in March there was a blip. It slowed down a bit with everything that happened, with all the news that came out of the White House. Things slowed down a bit. But as the interview and the fireside conversation went earlier, we haven't seen retail investors, the public, enter the marketplace yet, regardless. Which I don't think is that unusual. I think it's more significant this year because of two issues. That's cannabis and blockchain, I believe. I think a lot of the retail investors, which are often the risk capital in the marketplace, which supports the junior and development stage in the sector, in the mining sector, have been somewhat distracted by the cannabis and blockchain phenom. So I expect, certainly a popular view, is that the cannabis, for instance, blockchain to a lesser extent, because a lot of retail investors are having a hard time understanding blockchain, but cannabis certainly.
I'm having a hard time understanding it.
It's a big distraction. And it's as far as mining is concerned and investors returning to the market, that risk capital, I think we have about a year or so, because cannabis has sort of run wild, untamed. You have companies with 50 million revenue trading at a billion
do you think the
market cap.
The industry generally, and exchanges particularly, have done enough to explain the mining industry to retail investors? I ask because I do a series of explaining mining to non-miners, and without exception, I struggle to explain deposits and grades and how deposits flex depending on the metal price, and so grades change, and it just blows people that it's not just what you're told, it changes with time. And these guys are expecting to invest in junior companies, and they don't actually get the basics of the whole industry. Not convinced there's enough training going on that explains it to the retail world before they invest in juniors. I don't know if it's different in...
You want to take it?
Yeah, it's look, it's the Canadian banks and the Canadian investment culture is slightly unique on that equation, where most of our product goes a minimum of 30% retail, and it's partially the way the Canadian banking system is structured, and all of the Canadian banks have broker-dealers and have a retail conduit and a research platform, so that, in particular, high net worth, but generally the aggregators of retail have access to that research. So I have to say it works fairly well, but it only gets put through the retail system if the institutional system is working. We can't, the retail doesn't support any of those three public offerings that you mentioned. It has to be supported by the institutional market. The UK market it doesn't have the same platform for retail, and I share your. It's a highly technical industry that's not for the weak-hearted, right?
Talking of technical, Dean, we were talking earlier, and you said there's a wide divergence between the bid and ask on M&A valuations for good assets. Can you give the audience some idea of the strategies that you're seeing companies pursue for M&A in the current market?
Sorry, what's the specific question?
The wide divergence between the bid and ask prices on valuations for assets.
Yeah.
And are there any strategies?
One of the things we're seeing is, on good assets, valuations are, the differential is pretty large. And we have lots of clients who are, obviously they still want to participate, they want to have access to resources, but, they can't possibly take some of these valuations to their boards and get it through, because from a capital allocation point of view, they don't want to get killed by their shareholders. So things that we're seeing a lot more of, which I don't think the strategics typically would have done before, as you've seen, partnership is now a very important element of many of the strategics, where and they really believe it in the sense that they want to partner with people on joint ventures and other arrangements to create value, not only for themselves, but for everyone. So that is an area where there has been quite a lot of activity, and you've seen some very interesting joint ventures that have been done over time, including some in South America where, Teck and Goldcorp took two assets, put them together, where individually they might not have been as strong, but together they were a stronger package. I think you're going to see a lot more of that. The other thing we're seeing is people are getting their heads around minority positions more, whether it's in the public company itself, it's in a joint venture, and then it's linked to taking offtake or something like offtake, streaming or whatever. And the idea is to get access to the underlying economics, to get access to the product, potentially to trade and so on. So, obviously you have Glencore and the other traders who have very, very big marketing books, but I think you're seeing other people trying to build their books over time as well. So more activity in both those fronts, where traditional M&A is harder.
Okay.
I think, and a good example of that is Pierre mentioned earlier London Gold's recent deal with Newmont in Ecuador.
Newcrest.
Newcrest, sorry. Yeah. in Ecuador. So that's a good example of what you're saying. And I think coming out of the downturn, we're still at the early stage of coming out of that downturn. Investors' minds are still fresh, and majors are still hesitant of being slapped again for some of the large acquisitions that were done that didn't quite work out very well for investors. So there is that caution and discipline that's still in the marketplace, and I think only after you get deep into a recovery, you get to the peak where there's irrational exuberance. I think we're far from that.
The last question I had is, assuming a trade war can be averted, which is looking more encouraging every day now, which commodities and companies are best positioned to benefit from this uptrend? I presume battery metals are top of mind, but anything particular?
Any commodity Ross Beatty invests in.
No, I think going back to the supply and demand question that we started out with, the economy is driving a large part of the demand. And of course, base metals are at the front of that. Copper is always the leader. And we're seeing that in the market as well. As I mentioned, the 3 IPOs that started us out last in Q4, which we call the return to mining, we're all base metals, right? So we expect the global economic performance that's forecasted to drive base metals to be a hot sector. And of course, as you mentioned, battery metals, what's happening with that? Yeah. With the battery metals, lithium, cobalt, and graphite to a lagging extent.
The other thing you're seeing, and it's a related trend, obviously, is as the world and China in particular try and get cleaner, if you want to call it that, some commodities are differentiating where they didn't differentiate before. So take iron ore as an example, which usually traded, pellets and certain grades of iron ore traded within a tight band. If you look at the chart on iron ore for the last year, there's been a wide divergence between high quality concentrate and pellets and lower quality iron ore. And that's a trend that probably mostly relates to the environmental concerns, and I think you're going to see more of that in other areas as well over time.
And regionally, has Donald Trump done for Russia? It's a cryptic question, really. I think we better wrap it up there. I'm getting, there's obviously a lot of thirsty folk in the audience. If you've got any questions from the audience, please speak to the panelists during the drinks. Thank you very much. Please thank the panelists.
Thank you.